All right, guys, next up, central bank prep. So now we know a fair bit about a central bank. Let's put some of this into practice. So we're going to look at how do you prepare for a central bank decision. This is a Fed decision. And at the end, I'm going to leave you guys to go and trade it. Now, the advice I will give you when trading it is go and trade it without the decision and then try and answer what the decision was. That's a good test of the prep. We'll also then get the chance to prepare for another central bank and do that in real time as the days and weeks go by. Right then, central bank prep. Let's get going. You need a simple framework. This is similar to if you're trading economic data. You need a clear framework for what you're going to do. Now, what you've essentially got to do is assess various different things, starting off current policy, guidance, what the market's pricing, because it's one thing to understand where the central bank thinks they're going and another to understand where the market thinks it is going. One of them could be wrong if they're not both pointing at the same thing. Something's then going to change. This is a good barometer for opportunity. If these things don't line up, it's fair to say there's a good chance. Communication. What has been said since the previous meeting, and then from all of that, defining what and where your opportunities lie. This is going to be a Fed example. So we'll work through from what we were looking at earlier on. Right, so what you've got to do is you've got to assess the value of each meeting. Not every central bank meeting is a massive opportunity. Some of them are pretty stale because it is very clear already where the options are and where the opportunities lie. The more predictable policy is, the less the opportunities are. So, are there any opportunities? What you need to understand is what are the current policies at the moment? Does the central bank have a rate-based policy? Do they have QE? Are there outstanding repos? What are the things that could change ultimately? That's the question that you want to be looking at. You then need to be looking at policy guidance. This comes from the statement, and we'll be breaking down the statement in a little bit. These are your taglines. So things that are used within the statement to indicate policy going forward. You don't need to have read and memorized every part of every statement. What you need to understand is the structure of the statement and what each part of it tells you about policy going forward. So what conditions are there? Again, this is an area that can change. They don't have to change the actual policy to have an impact, and arguably sometimes the bigger impact comes from the guidance shift more so than the policy shift. If policy is going to change, it's fair to assume that the central bank will have already lent the market the idea, guided the market towards it. So policy guidance can often be the indication of change, which effectively starts the pricing in of the change. What's happened since the last meeting? Because whilst from where you were, it may well have been quite clear what the policy was and what it's going to change to. What's happened since, though, can change that dramatically. COVID, for example, is a prime example. Moving into COVID, the expectation was very clearly that the Fed was going to stay stable on rates and eventually start to raise them as 2020 went on. Developments happened between January and March that meant absolutely that was not the case, and the Fed cut rates dramatically. So, developments, that's a very extreme case, will impact the upcoming decision. So you need to understand what currently is the important thing that the central bank is looking at. Are they looking at inflation? Are they looking at growth, unemployment? Are they looking at an external factor? What matters? Because that, again, is going to allow you to kind of see where they could go. What is becoming more or less likely? In some situations, it's going to be clear that the opportunity or the policy shift is either going to be raise rates or nothing. Other situations, it will be cut rates or nothing. And in the very rare occasions, you have a situation where it could be a rate hike, it could be a rate cut, or at least a hike or a hike even more. So multiple opportunities. Equally, between last time and this time, there's communication. Central bankers will talk, they will produce statements, have press conferences between meetings to explain policy going forward. This sets your expectations. Remember, we talked about how important expectations are. And then you've got to work out what your options are. This isn't options, as in the instrument. This is, what are your options? What can you do? So, a lot of this is down to market selection. Which market's the best place to move? Which markets have already done a large move and are arguably skewed in one direction from where you currently are? That's how you conclude what your opportunities are. Always think, whenever you're going through your sort of trading framework or your preparation framework, The ultimate goal of this is to define where your opportunities lie. You cannot go into a central bank decision with a view of, I'll see what the market tells me, I'll see how it reacts. If you understand where the opportunities are, then you have an expectation of what it should do. Therefore, you're ready to react in a certain way. If they do this, you're going to look for that move. You can trade that move immediately, rather than wait for a move to happen and then go, oh yeah, it must have been that. Right. Quick overview. We know what the central bank's there to do. We know what the Fed's mandate is, maximum employment and price stability. This is the specifics of it. Assessment of the shortfalls of employment for its maximum, and in terms of their price stability, seeks to achieve inflation averages 2% over time. Following periods when inflation has been running persistently below 2%, appropriate policy will likely aim to achieve inflation moderately above 2% for some time. So essentially their goal is to actually swing inflation from one side or the other of 2%, averaging 2% in the long term. We know this, but that's just a reminder of what their policy is geared towards. And understanding this is important because now it allows you to assess data from the perspective of, does it adhere to where they are in their mandate? Does their mandate match the data, or does the data mean that they need a policy change in order to try and get it in line with their mandate? Right. The thing that we've not looked at so far is who gets to vote. A central bank is not one person. There are a number of people who form the decision-making part of a central bank. Now, the way the Fed operates is you have 12 reserve banks. These were originally individual banks on their central banks in their own right that dealt with certain areas of the US, Dallas, San Francisco, New York, etc., etc. There's 12 of these. You also have a board of governors. So that creates the Federal Reserve System. That's all of these folk here. What you have in terms of who makes the decisions is the Federal Open Market Committee. Now this is made up of 7 members of the board, plus the president of the Bank of New York and 4 of the other Reserve Bank presidents. So of the 12 reserve banks, there will be 7 of them making a decision. Sorry, 5 of them. The head of the New York Central Bank, John Williams, in this case, plus 4 of the others, which are the ones in bold. And the board members, at this point, Jefferson, Cook, Barr, Bowman, Waller, and of course, Brainard, the vice chair, and the chairman, Powell. So they're the people making the decisions. What's important to understand with who's making the decision, you don't need to know the names of everybody, but you need to know who is a voter. Because whilst these people can do press conferences, release statements, go to interviews, etc., voice their opinion on policy, if they're not a voter in that current year, it doesn't really matter because they can't sway the votes. They can be part of the discussions on what to do, but they cannot actually have a say in what really will happen. So, what's very important in this example is that the 3 most dovish central bankers, when I say dovish, what I mean by dovish is the 3 who are most inclined to allow inflation to run hot, to not be keen on a rate hike, are not voters. The simple way of thinking about dovish to hawkish, the more dovish you are, think you want rate cuts. The more hawkish you are, think you want rate hikes. Now, of course, if you're in a rate hiking cycle, then realistically what happens is these people want less hikes, these people want more hikes. So bigger and faster from Mester, Waller and Bullard, slower and smaller from Kashkari, Evans and Daly. That's the basics of it. There are 8 meetings per year from the Fed. Most central banks have now adopted this strategy of 8 meetings, 1 every 6 weeks, roughly. What this does do is it gives them 4 very distinct end of quarter meetings, and they're generally the important ones. So that's the voting structure. It's worth knowing who's voting, worth knowing in particular if there's names that you need to know with the Fed, you need to know the name of the vice chair, the chair, and the head of the New York Central Bank. They're the key ones. Apart from that, if you're going to try and memorize anybody else, the rest of the board members. As a general rule, anything from Bullard is, or has been throughout 2022, extremely hawkish. There have been periods, however, where Bullard has equally been extremely dovish. If anything, Bullard is somebody who can swing very wildly in view. doesn't sit in the middle. He will either go from one side to the other. As a general rule, Mester, George consistently has been hawkish for a long period of time, less so now that rate hikes are actually starting in this instance. Right, meeting format. Like I said, you have 8 meetings per year. What you get with the Fed that's important, and I will come on to this in a minute, is at the quarterly meetings, March, June, September and December, you get dots. What dots are, I'll give you an example of this in a little bit, is each member's view on what the rates will be at the end of the prevailing year. So the current year, the next year, the following year, and the long term. This serves as a way of giving an indication of where rates are likely to go. So you have a dispersion of dots because people will want varying different rates. So you have what's called a dot plot, where people will have voted for different rates, i.e. like that. And the median rate is the one that you will get shown, which essentially is the median view of all members. The more dispersed the dots are, the less agreement. The more closely dispersed they are, the more agreement. So it gives a sense. It's a way of them guiding the market in a quantitative way without saying who's voted for what. So you just see a dot and you don't know whose dot is what. I'll give you an example if you're wondering exactly what I'm talking about. Central banks will generally have a blackout period. What a blackout period is a week before the policy decision where no member of the central bank is allowed to speak about monetary policy. Now, as the years have gone by, I would say particularly in the last 10 years, these blackout periods have been less and less well adhered to. Commonly and predominantly started by the ECB would release sources. Somebody within the ECB would phone up a newspaper, or Reuters, Bloomberg, CNBC, whoever, say, oh, by the way, at the next meeting, we're looking at actually raising rates by more than was expected. Oh no, roughly. This will then get published. This is used as a way of guiding the market right up to the day of the meeting without misaligning with the blackout period. The Fed has also started this to a degree and has started generally releasing information to the Wall Street Journal. That's been the favoured media outlet for what's been seen throughout 2022. These things can change, but that has become a little bit of the thing. Many years back, it was John Hilsenrath who was the journalist who generally got these pieces of information. It is now a guy called Timoros. I can't remember his first name, but someone Timoros is the man at the Wall Street Journal who seems to get the stuff. Right, in terms of what happens, at the meeting you get the policy release. This is a statement that tells you what they have done and a brief explanation as to why they have done what they have done, including guidance on what is likely to come next. So this is the policy statement. Half an hour later, you will have a press conference. Within the press conference, there will be an elaboration of the statement, as well as Q&A, which will form the majority of the press conference. Press conference will last around an hour and will include roughly 10 minutes of explanation or elaboration on the statement more broadly, followed by about 45 to 50 minutes of Q&A, where Powell, in this instance, will get quizzed on why they've done certain things, what they are likely to do in future, what the Fed is seeing as important currently, and how that's likely to influence policy going forward. So that's what they're going to get quizzed on. You also get minutes 3 weeks after the decision. Obviously, the decision is made, and that's what they explain. The minutes will explain the discussion that went into the decision. So it will then also give you a sense as to where the discussion is leaning. If the minutes suggest that most people are talking about rate hikes, then that very much wipes away the possibility of rate cuts. So it gives you information about the next decision by way of understanding the trajectory of what was discussed in the previous decision. This can, in some circumstances, be a tradable opportunity. Right, statement science. The key bit with a central bank statement is to understand what their message they're trying to communicate, rather than just seeing this as a statement of information. There are elements within each statement that try to communicate specific things. Most central banks have a statement that follows a reasonably consistent format. And so the wording of that format, small shifts within that wording, tells you very clearly where they're going next. We looked at this very briefly with central banks and their changing of accommodative and then not appropriate, restrictive, ongoing increases, etc. It gives the market a sense as to future direction, manages expectations. So, This is there to avert the idea of surprise, and we talked about that before. What you're looking for then is taglines relating to specific things, what they have changed. Now, these will relate to things like their judgment of inflation. How are they viewing inflation? And they will describe this. I'll break down a statement in a moment for you. How they describe inflation. We'll look at their assessment of the current situation. Things like how they describe risks. Are there risks to the downside? Are there risks to the upside? So what they mean by that is if there is an upside risk to inflation, they think that inflation is more likely to go higher than expected rather than not continue to rise, rather than downside risks. So it's the way that they qualify some of the information that helps. There will be statement structure. As I said, statements generally follow a consistent structure. If the structure changes, this is a clue, because this tells you very quickly, if they shift part of the statement up and start talking about that immediately, that is very much the focus. So statement structure matters. The fact that the statement is released as a whole immediately means that generally actually seeing the structure won't tell you a huge amount. But understanding how structure is changing can be important. So know what the standard format is. If nothing else, when you're going back through statements, it helps you to go back through and go, okay, I know the areas where I need to look. I know the things that can change, the things that if they do change, they don't really matter. Look as well at the history of changes. So if you're expecting a certain type of action, go and look at when a similar action has happened, even if that was 10 years ago. Because the phrasing used in the meetings before that action is often phrasing that is used again. So you can preempt certain actions by way of understanding what has previously been used to communicate them. Like we looked at previously, the dropping of accommodative is roughly a 2-meeting heads up to an action. Be that up or down. It doesn't give indication as to which direction, but dropping accommodative, generally 2 meetings later you get action, is a rough rule. So you can see these types of patterns coming together. You can see what change might be needed and also what the change might be to, so you know what words to look for to know what could come. If you see this word, that from historic can tell you this means this. A couple of examples. The ECB is very good at this, that they have used the phrase tasking committees in the past. When they use the phrase tasking committees, what this means is they are going to assess the viability of a certain type of action. You likely know what that action is. So let's say the economy is struggling and they say they are going to task committees with looking at the impact of certain data. That basically means we're going to assess this data likely with the view to cut interest rates. They will then suggest that at the next meeting there will be a thorough reassessment of policy, or a reassessment, a reevaluation. Words to that effect basically mean current policy isn't right, next time we're going to assess it and change it. So these phrases give you the heads up as to what's going to happen. So by the time the next meeting comes around, and let's say they cut interest rates, you knew that was coming. And the trade was on the meeting before. The very old example from the ECB is they had very clear guidance where they would suggest that they are vigilant on inflation, and then they were strongly vigilant on inflation, which meant next time they're going to raise rates. They would raise rates and say they will now closely monitor inflation before saying they are vigilant, strongly vigilant, and then raise rates. And that was a very consistent pattern. There's a trader who's got a horse, I believe, called Strong Vigilance for that exact reason. There's also explicit guidance where, and the Fed is a fan of this, they will say at the next meeting we are likely to change in a certain way. So these things will either come into the statement or into the press conference. So let's have a little look at statement. This statement from the Fed from May, I believe, 2022. They will first give an indication of the current situation. Now, what you're interested in here is a few key bits. You're interested in their assessment of economic activity. It has, in this instance, edged down. Household spending, business fixed investment remains strong. So it's the qualifiers. Job gains, robust. Unemployment rate has declined substantially. This is the key one. Inflation remains elevated. So they're the key things you're interested in. economic activity, job gains, and inflation, and the qualifications of those. In this instance, edge down, robust, and remains elevated. You're looking at these to change. If inflation has moderated, what that implies is it is no longer too high, or it is maybe too high, but it's not going to stay too high. Begun to fall. You can tell by what word is used the trajectory of these types of things. There is often a global aspect, particularly if there is external factors. In this case, the invasion of Ukraine by Russia, tremendous human and economic hardship. You have to be blunt with these things. Is that an opportunity to trade? No, that is stating facts or stating the obvious. It has caused hardship. The implications to the economy are highly uncertain. Is that tradable? Not really. If it's uncertain, you don't know what their response is going to be. However, the invasion and related events are creating upward pressure on inflation and are likely to weigh on economic activity, coming back to what we talked about. This is important. This basically says the risks are that inflation can go up and economic activity can go down, stagflation. That's something they're clearly worried about and feeds into their decision. Over time, a statement like this will change because this situation in Ukraine and Russia is no longer going to be there. So this part of the statement will change and in some instances will completely disappear. The clarification of what this means is that the committee is highly attentive to inflation risks. That's the thing that you're after. So inflation is the big thing for them. That's what matters, which now tells you if you look at inflation, changes in inflation going into the next meeting, this tells you potentially what they may well do with rates. So that gives you the kind of summary as to where they are, what's factored into their decision. Here's the decision. They reference the mandate, seek maximum employment inflation of 2%, appropriate firming of the stance of policy. The committee expects inflation to return to 2% objective and the labour market to remain strong. So, with appropriate firming, i.e. we are on an upward path of rates. So, that's the take from that. In support of these goals, they decided to raise rates. So what have they done? They have raised rates to 0.75% to 1%. The Fed rate is a target range. So essentially they give you the interest on reserves and the repo rate in one. We won't go into administered rates, you can read up on that on yourself, but 0.25% to 1%. And anticipates, this is the forward guidance, ongoing increase in the target range will be appropriate. That's the information. So what that tells you, more of the same. That's the basic conclusion of that one. They're going to do a bit more. So they've raised rates by 50 basis points to 0.75% to 1%, and ongoing increase in the target range will be appropriate. In addition, decided to begin reducing holdings of treasuries and agency debt. This is QT. And they'll start that on the 1st of June, as described in their plans for reducing the size of the Fed's balance sheet. So, not massively new information because we already know this from plans. So that's where we currently are. What we know is that they are going to start reducing this. The important bit here is the ongoing increases. This broad guidance is kind of giving you a summary of what they are going to think about when changing in future. They'll assess the appropriate stance of policy, continue to monitor income and implications of income and information for the economic outlook, would be prepared to adjust policy as appropriate if risks emerge that could impede the attainment of the committee's goals. They'll take into account a wide range of information, public health, labour market conditions, inflation expectations, financial and international developments. Essentially, we're going to look at all of these things to be able to next time tell you where we are, tell you what else is going on and change this. That's roughly what this bit means. This is generally reasonably unimportant. So that's your bit on statement side. You can break this down then very quickly to there are a few key things. Qualification of certain key metrics. Their judgment of the stance, which is somewhat less important compared to the ongoing increases, which is their guidance. That is the most important thing. Change to that matters. That's significant. Of course, change to guidance only matters if the change in policy is in line with what the market expects. That's key. So there is a order of priority of these pieces of information. After that, In the clarification, you will get the Q&A, where Powell or Lagarde if it's the ECB, Bailey if it's the Bank of England at this point in time at the end of 2022, will be asked various questions. They will also give a further assessment of what has gone on, a more in-depth statement essentially. So, what do we take from it? Just to clarify, rather than inflation remaining elevated, he goes a step further. Inflation is much too high. That implies very clearly that they still need to do something about it. We're on a path to move policy rate expeditiously to more normal levels, i.e. quickly to get there, and 50 basis point rate hike is on the table for the next couple of meetings. So what he's doing is pre-preparing the market here. It's not just ongoing increases, but he's basically qualifying the ongoing equals 50 and 50 and potentially more. So that's now essentially giving a quantity to the qualifying language. That's what ongoing can now be assumed to mean. When asked, would you consider 75 basis points, i.e. 0.75% increase, not something considering. We are not actively considering it. And then goes back to repeat the line, the broad sense that additional 50 basis point increases should be on the table for the next couple of meetings. What that does mean is he's not suggesting that it necessarily has to be any more. That's also the implication. The next couple obviously implies 2, and so maybe not anything more than that. And that's important. They were the key moments of this speech. You know what the key moments are because the market will react. So let's go and have a look at what exactly happened. So there were 3 key parts to this, and what I've got here is gold, S&P, euro. So this gives you a sense as to market direction on these as well. So first take, the blue arrow. So I've put the wording at different phases along the way. Blue arrow, so it's the same point on each chart. Blue arrow, inflation much too high. This was his first thing. This is taken hawkishly. The market's interpretation of this is inflation much too high, rates are going to rise faster. More rate hikes. Dollar strengthens, that's what this drop is all about. But you're looking at how far these moves go. That's about 40 ticks. The S&P drops around about 40 big ticks, so 40 handles, and gold drops around about 120 ticks in the course of 3 minutes, 4 minutes. Markets then stabilize a little bit. Next up, you get 50 basis point hikes on the table for the next couple of meetings. Because there had already been some talk of 75 in the run up to this, market takes this as relatively dovish. This is essentially saying, maybe not. There might not be as much as you think. It's only 50. So then you get this steady bounce back. Markets start to rally a touch. Next up, the question about 75. This he is absolutely crystal clear on. Not considering 75 basis point hikes. This is the moment that the biggest move of the entire day comes. Because here, he has basically ruled out what some people are expecting. So if you think about it in terms of pricing, they've got 50. Some people are thinking next time we might go to 75. And what he's done is he's gone, absolutely not, 50. So if you think about what was kind of expected, so if you imagine they've now raised 50, so next time the expectation is between 50 and 75. So if you think that the market believes the rate will either go up by 50 or up by 75, and the market is probably somewhere in the middle in terms of pricing. So there is an expectation that it could be either. When he says not considering 25, the way that the market prices this is effectively, let's say this is halfway between, so 62.5. That is basis point rate hike at the next meeting. So this is next time, expectations. If that's where the market currently is, by saying it will not be 75, this is equivalent to a 12.5 basis point rate cut. That's the effective action. Because the market needs to price that this is not happening. So it's not possibly happening, it is not happening, therefore it is this, which means that it is now not 62.5% priced, 62.5 basis point priced, it's 50. Essentially a 12.5 basis point rate cut just on the language. So what happens? The euro flies. 15 minutes, it is up around about 70 ticks. The S&P is up around 50 big handles and then continues onwards for another 80. Gold, after having already bounced, now puts in a rally of 200 ticks in 15 minutes. That's the scale of the movement. Very clear, and it all comes down to that one very simple phrase, not considering 75. He has wiped the floor with that idea, not going to happen. That's the takeaway. So, from there, you've now got to say, right, we know what the policy is, we know what the Fed is saying is going to happen. Remember, they've said 50. So now you've got to look at data. How's the data changing between last time at the beginning of May and this time in the middle of June? Is there a policy response needed? Do they need to do something? Now we know that they're probably going to do 50, so the question is not do they need to, it's how much. Is it still 50 that they need to do? And you can then look at how the market has priced this. You can look at market pricing to answer this question. That if they're going to have a policy response, how big is it going to be? What are they going to do? And then you can assess the implication that that has for the decision. So, we know what data matters. If they've referenced certain measures or has specific targets, like they said in the last statement, they are very aware of inflation. That was the bit in the global aspect. I don't think I paraphrased that precisely, but they are clearly very aware about the risk to inflation. That's what matters. So, you can then look at how markets have moved. Because what this allows you to do when it comes to implication is decide what actually has the scope to move. If markets have all steadily dropped into the decision, well, what they're doing is they're pricing in the decision. Now, if the decision comes in line with the pricing, it's very hard to keep going. Even if the decision is more extreme, it's hard to keep going because this move has already happened. However, anything in the other direction could well produce a rather dramatic move. I'll explain this with charts in a moment and the kind of thought process in terms of people's positioning and market pricing. These are the things you really need to understand. Because the thing that moves a market on a decision is not necessarily the decision, it's how well the decision relates to how the market has already priced it. If you think this is going to happen, and it happens, nothing happens in the markets. Even if it is a rate hike, if everyone thinks it's going to be a rate hike, nothing happens. If it happens and it's a surprise, everyone now needs to readjust. That's what you're trying to get at. So, what you're looking essentially to try and ascertain from this information is the likelihood of action and the element of surprise. That's what you want to understand. Are we going to see something, and what's the potential for this to be a surprise? The more unclear the markets are priced, the more surprise there is. The more clearly that they're priced, you've not got much opportunity. So if the market price is 50 for next time, which is exactly what they've said they're going to do, chances are that's exactly what you're going to get. There's not a trade on this. So what has happened? Well, since the last time, inflation has gone up, continued towards the upside. The big thing as well that changed, and this was where a piece of data that typically isn't focused on got big focus. University of Michigan 5-year inflation expectations. That's what they ask about. So University of Michigan does a survey where essentially they phone people up and say, what do you think inflation is going to do over the next 5 years? And a fair variety of the population said, we think this. So they will publish that data. What that tells you is now what the economy thinks. Essentially, the consumers, the people are the economy. If they think inflation is rising, that will feed into an inflation. Like I said earlier, if I expect inflation to rise, I will buy stuff now before it gets more expensive, which will cause inflation to rise. So if expectations of inflation are rising, inflation will follow suit. Inflation is already rising as well. This may well now mean that rates might need to rise faster. That would be the implication. What you also get into meeting is this sense of sources. Wall Street Journal article comes out, which essentially says, in light of recent CPI data and Michigan data, the Fed members are now considering a 75 basis point rate hike, contrary to what they just said in the last meeting, which was 6 weeks ago. So there's a fair bit of time for things to change. So what happens? Well, on the Friday before the Fed decision, you get CPI. CPI data, inflation data, is higher. This is a 30-year bond, this is a 2-year bond. Now inflation typically is a 30-year impact, 10-year, 30-year long end of the curve impact. But remember, at the moment, at this point in time, inflation directly will lead to rate hikes. So inflation data has a very, very big impact on 2-year bonds. Essentially, inflation data is not traded as inflation data. It is traded on the likelihood of a rate hike or the likelihood of a larger than expected rate hike. That was the way inflation was traded in a very high inflation environment. Very high inflation theme driven environment, I should point out. So CPI data comes out. You look at what happens on the 2-year. 2-year drops, pricing in rate hikes. The Michigan data comes out an hour later and the drop continues. The Wall Street Journal article comes out. The 30-year continues to drop. The 2-year continues to drop. And they both continue to drop into the Fed decision. This is a huge move compared to what had been recently going on. It's an absolutely gigantic move. For the 2-year bond, just to put it in a bit of perspective, this is just over a full point move. A full point in 2-year bonds is enormous. And I can't quite stress how big a deal that is. If you put it onto a bigger time frame chart, and somebody asked me about that, and I'll find a bigger time frame chart for you, and I'll show you just the scale of how big a deal that move is. So that's massive. So what this is doing is pricing in 75 now. And you can see this very clearly when you look at pricing. The dollar also strengthens, and this perhaps gives you good context of it. This is a 240-minute chart of the dollar since the previous meeting. And what you have, there's the CPI data. So over the course of 2 days post the CPI data, pre the Fed decision, the euro takes out 4 weeks of rally. It's a massive move again. This has moved from 108 to 104, or 104 and a half. It's massive. That move in 3 days is as big as this move over the course of a week. So again, very, very big move, big dollar strength because everybody now is looking for a 75 basis point rate hike and potentially more. Oops, you've gone the wrong way. We talked about this before, the intermeeting guidance. So with that data, and bearing in mind this is in the blackout period, so they can't guide, the only guidance that we've had was the Wall Street Journal article. That was the most recent thing. Now we know what they're trying to do with the guidance. They're trying to make sure that a surprise is not there. And the way that they do this is through press conferences. We talked about sources already, press conferences, articles in newspapers, all of these ways that central bankers can communicate. Now, what you're interested in and what you're looking at is one, the important people in that list of hawks and doves. And again, I can give you a link to where to find that. You're looking at who the important people are and what they say. You're also looking at the trend of comments. Are comments generally more leaning towards hawkish or are they more leaning towards dovish? So the trend of comments matters. The comments can also sometimes become part of language. Powell's use of the word patient at the beginning of 2019, for example, came from a speech that he made in January. He made a speech in January where he suggested that the Fed would now be patient on their next decision on rates. This then became part of the statement language. So expeditious was used in the last statement or the last Q&A, and something that he'd used before. This again can become part of the language. And that what they're doing is they're trying to maintain consistency so that it is translatable. You know what expeditious means, and by continuing to use it, they're enforcing the idea that expeditious has a quantifiable amount in the same way that ongoing previously was seen as 50 then 50. So that's the goal. And you need to be looking at the trend of the comments. Also, who made the comments? Overwhelmingly, for a central bank, the most important person is the chair. So, comments from Powell in between the meeting prior to the Wall Street Journal article, which came out on the Monday before the meeting, saying Fed likely to consider 75 basis point hike. But Prior to this, Powell said allowing inflation would mean a deeper turndown. It would be appropriate for there to be additional 55 basis point rate hike at the next 2 meetings. So, not changing his line there in between meetings. Prepared to do less, if worse, we're prepared to do more. So again, still very much towing the line that they don't have to keep on going at this pace. Markets pricing a series of hikes. The economy is very much uncertain, difficult to think about giving forward guidance. So he very much doesn't want to give too much forward guidance, doesn't want to pre-commit to too much. Good to see markets reacting to what we're saying. Conditions overall have tightened significantly. So basically what he's saying is, this is where we're going with it, and it's good to see that markets generally are agreeing with that. And prior to the blackout and the CPI, they were. Again, repeats that in another press conference, and they're seeing a series of hikes coming. So, Powell very much has told us where they're going. They're going with what they had last time, and that's what their expectation is, until this article comes out. When that article comes out, the pricing shifts. This is a fantastic website. What this is the CME Fed Tracker. So Google that, just type CME Fed Tracker. What it shows you is the market pricing of certain things. So in this instance, this shows the market pricing of different rates. So for the rate to be 150 to 175, i.e. a 75 basis point hike, the market is now pricing, when I say the market, Fed funds market, so short-term interbank market is pricing a 93% chance that rates are going to go up by 75 basis points. It also shows you how the probability has changed. 1 week before this, the chance of this was 3.9%. So that's how much that CPI and Wall Street Journal article has impacted market pricing. Everybody thinks it's 75 basis points now. So whilst 75 would have been an enormous surprise previously, after that CPI, 75 is now the overwhelming expectation, which tells you if the Fed raises rates by anything other than 75, there is a massive move potential. Because if they do 50, as they had promised last time, this pricing needs to go over here, which essentially is a very dovish pricing. So what would need to happen, and what you would expect to see, is bond prices go straight up, basically back to where they came from on the CPI drop. You would expect to see equities and gold and the euro dollar, so dollar weakness, follow the bonds up. That would be your overwhelming expectation if they do 50 and not 75. If they do 75, do we need to do anything more? No. There is 6% of pricing left to do. That's minuscule. And that could be done with a little bit of variation. And it's never going to price absolute perfect. So, the market has moved, it has priced a certain thing in, and it has priced it in very, very clearly. There will be other decisions where you come to the decision, and this is bang 50-50. They're great, because that means whatever happens, there's an opportunity. This, you've now only got an opportunity on 50, and if it's not 50, it's highly unlikely to be 100 basis points. If it's not 50, there's no action on it, there's no opportunity. So, expectations and pricing. Sorry, didn't need animation on that. From the CME website, you can also get probabilities going forward. What the probabilities show you is what the market thinks rates will be at certain meetings going forward. So for this one, they're looking at 75 basis point hike, followed by another 75, then a 50, then a 50, then a 25. We know, in fact, that the reality of this was, by the end of 2022, that it was 75, followed by 75, followed by 75, followed by 50, followed by 25. So the market was pretty much bang on in the middle of the year as to where rates would get to. Right. So let's go on. I apologise, I will just correct myself. 75, followed then by another 75, followed then by another 75, followed then by another 50. So by the end of the year, that's where they actually got to, that's where they expected in June. Now these are important prices because they tell you where the market thinks the dots are going to go, particularly the end of each year. So that's the expectation on dots. This is also the forward inflation expectations, which you can get from the St. Louis Federal Reserve Bank. Google Fred forward inflation expectations, and this will give you it. Again, something I can send the link over to. So, how do you define your expectations? Go and read research. When I say go and read research, anything you can get your hands on. CNBC, Financial Times, Wall Street Journal, Bloomberg, Reuters, any of these articles that you can find. Go on Twitter and follow people who talk about the Fed. Get a sense as to what most people expect, because that gives you a sense equally of the market pricing as well as what most expectations are. You can get a disconnect between expectations and market pricing. Now, what that means is if the expectations come in line, as in what analysts expect, and that's different to market pricing, you still get a move. Because you've always got to think, where is the market now? And based on that, based on what happens, where should the market go? That's the way you have to think about it. So whilst you can have a result that is absolutely in line with what economists think, if that's not what the market thinks, which you can get from the CME FedWatch tool, you can also get by looking at overnight index swap rates, which again, you can Google these. These are generally harder to find though. Overnight index swap rates are going to be the most accurate indication of where exactly rates are going to go. We'll get into this with crisis management on what exactly an OIS is and what it shows you, but we will deal with that in a little while. So that's really important. Once you've got that understanding of expectations versus pricing, now you can start to conclude where your opportunities lie. So, next thing is the dot plot. What we've got here then, and again you can get this from the CME FedWatch tool, is your dot plot. Like I said, the dots, each dot is one member's view of what the rates will be at the end of 22, 23, 24 and the long run. These were the March 2015 dots. So at the beginning of March the March 2015 meeting, sorry, March 2022 meeting on the 15th of March, this is what people expected the rates to be. The median rate, the rate that has the most evenness either side of it, at this point in time was 1.875, i.e. 1.75 to 2%. Now, if we go back to what the market thinks 3.625, so the rate will be 3.5 to 3.75. The difference, as you can see there, is immense. So what this tells you is these dots are outdated, and we know we're going to get new dots come the June meeting. So the little red dot is where the market thinks, and the dots are where the Fed thought in March. Obviously things have changed, so the question then is, do the dots go and line up with the market pricing? And if they don't, the market is then likely to move towards the dots because then they're updated. Of course, the pricing doesn't match up at the moment. This is 3 months later. So it makes sense that they don't match up. So then it's the question of, has the market gone too far? In which case it will come back down towards where the dot goes, or does the dot go even further, in which case the market can still continue to go higher. So that's what you're interested in. Just from the pricing, it's a fair guess that the dot is likely to move up somewhere into this region. Would be a reasonably fair guess. And that's for 2022, you've then got 23 and 24. So, the last 3 dots at this point in time. This was the last one. So this would have been June, so a year back. Expectation, 2022, there would be, the last 3, sorry. So it's now 1.875, which is here. This December one was 0.875, and the September one, so 6 months prior to this, the expectation was there will be no increase in rates for the entirety of 2022. 2023, this is now where you've got to. And 2024, the expectation is basically there will be no change in rates in 2024. So that's the implication. So what this is basically saying to you is that rates are going to do that plateau out. They'll rise through 2022 and then they'll stop. Another way to look at it is to look at what the current rate is and use this to then assess how much the total number of rates are going to be over the coming year or over the coming 2 years. So let's go and have a little look at the overall expectations. This is what the market is pricing, what analysts think is going to happen. So first up, analysts originally going for 50 basis point hike, so 1.25 to 50. Market's pricing 175 or 150 to 175. So this is a 70 and also another 75 in July. So from last meeting, Powell said they would do 50, then 50. Analysts up their views, then to expect 50, then 75, then 50. The market thinks 75, then 75. And the peak rate, this is the highest rate that is expected for March 2023 at 4.425. So that gives you a sense then as to where people are expecting stuff to go. So the expectations are basically your assumptions. You can say, right, if it changes from these, then there's a trade. On the dots, expectations now, so this is from analyst expectations and things you read. You can't get market pricing on dots, really, that obviously. Increases with possible lower 2024. So expectation then is that the 2022 dot will go 2.625 to 875, 23 and 24. That was before the Wall Street Journal article. Post the Wall Street Journal article, these then went up. So that's what they then moved to. So if you round this, this would then be 2.8. You round this, that would then be 3.5, and then that would be 3.1. Post the Wall Street Journal article, this is where they're going up to, more like 3.4. So that's then adding on another 2 rate hikes. 3.9, so again adds on another 2, and then 3.1 is roughly then around about the same, or 3.1, 3.6 area, another 2. So the expectations have all been pushed up by this Wall Street Journal article. Language. There's not a great deal of expected change in the language. So expectation could go more hawkish, and the expectation is that ongoing may be replaced by expeditious. Q&A, the big question, of course, and we know this, will they hike 75 at the following meeting? That's an obvious question because he gave an answer last time. That's the big one that everybody wants to know the answer to. This is essentially a credibility issue now. What they don't want to do is say, oh, we'll do this next time and then not do it. So there's a likelihood that he's not going to give a clear answer to it. But nevertheless, what they don't want to do is risk the markets pushing them again like they did this time. The other thing that he's likely to be questioned on, and is a favourite question, market pricing, currently 50 basis points at the next 4 meetings. The question is likely to be along the lines of, is the market right in this? Does that align with the Fed's view, which essentially is shown by the dots? Excuse me. So that's what the questions are going to come around about, or likely to come around on. So we can then go and break these trades up, and the trades fall into a few different categories. You trade in a central bank, your scenarios can fall into a binary trade. This is typically a rate trade. So in this instance, the trade is very clear. If it's 50, it's very dovish. There's a straightforward trade. Buy bonds, buy equities, buy gold, sell dollars. Or if it's 75, do nothing. So that's your first port of call. That's your first opportunity. Then you have what I call a specified binary trade. So mostly because I don't necessarily know what the word is for multiple very distinct options, I'm calling it specified binary. What this would be is something like the dots, where you could say, if the dot is any number above this, it is hawkish. Any number below this, it is dovish. So therefore, you can define very clearly what is hawkish, what is dovish. And it could be any of those numbers. So it is specified in a range of numbers. So it is binary in the range of numbers, despite the fact there is not one number that the trade is done on, essentially. So it could be any of these, this, or this, has the same binary impact. That's a sell, that's a buy, if you will. That's the way to try and think about that. You have a similar thing on the vote breakdown on the Bank of England. The Bank of England has 9 members who vote. You can very clearly go with one or the other. Oh, sorry, they break down the vote, so they'll basically write, it was a 5-4 vote for a hike, which means 4 people voted against a hike. So that tells you something. In another scenario, it may be 9-0 for a hike. So that tells you that everybody agreed. And there's a trade then on the number of people who vote against a certain action that tells you the story about the likelihood of future action. Same principle. You then have varied outcome trade. Now, this is likely to be a trade if there is nothing clear on these. If the rates come in line, the dots come in line, this then may well become a trade based on economic forecasts. If we go back one, at the quarterly meetings from the Fed, you also get economic forecasts. Their expectations of unemployment, inflation, core inflation, and the Fed funds rate, as well as GDP going forward. So, you will get an expectation here. This is something that is varied, and the degree to the change impacts or changes the impact. What I mean by that is, if the inflation aspect goes up, but only by 0.1%, the impact of that is reasonably minimal. If the inflation aspect goes up by 1.5%, that is a bigger deal. So the scale of the change impacts the scale of the move. In this instance, this is pretty much null and void because these are the really key big ones. And then you have an interpretation trade. This is the interpretation of language. What does the language mean? Now, you have to try and vary your plan dependent upon what is said. So what I mean by this is, if these things don't change, this becomes more important. If these things change, then the interpretation of language doesn't become that important. But what it can do is limit or accentuate a movement. So let's say, for example, the rate hike is 75. That's what it's expected. So you wouldn't expect too much move. But if the rate hike is 75 and the language is expeditious, that will imply another 75 and kind of nail that on. So that will be tantamount to a rate hike, not because of what they've done in the policy, because that's what's expected, but because of the way they have termed it. A flip to that would be if they did 75 and then dropped ongoing increases, this would imply it's 75 and none or very little more, which goes against the pricing, would be seen as extremely dovish. So this often is a qualifier of what has already been said and can produce what you might call a hawkish hike or a dovish hike, i.e. is it a hike that implies more hikes, or is it a hike that implies less, or a varied pace? You've got to be thinking, when you're thinking about hawkish and dovish as well, in terms of future, there's two aspects. There is the size of future change and the pace of future change. Large change, now and next meeting, has a different impact to not quite so big change indefinitely going forward. So the pace can often be just as important as the size, and in some instances more important. So, where are your opportunities? This all comes down to then going, right, what's going to happen? So, on the rate, 75 basis points, this is priced. 50 basis points is dovish. There's your trade. On the dots are updated, remember? So, it is now going to be a case of 3.4, 3.9 and 3.4 again. And either side of that is going to be dovish or hawkish. That's the rough take there. So that's pretty simple. So if you do 75, immediately your next port of call is the dots. What changes? If the dots change, or if the dots come in line, it's then onto the language. So how could they change the language? They could indicate that they could move to restrictive policy, so more extreme than expeditious. That would be seen as hawkish. Expeditious coming in could indicate faster hikes, so they could suggest an expeditious firming of policy stance rather than an appropriate firming of policy stance would be a way to do this. So they could bring in expeditious and keep on going. You could also change the guidance path, continue increasing until clear and convincing evidence of inflation is falling. So what this would do is opens the door to more rate hikes. The implication of this, and you get these ideas from reading articles, it's not me coming up with various ways the Fed might change their communication. Ultimately, I'm not one of them, I'm not on the board, I don't know precisely the wording, but there are people who will have experienced these things, people who've been on the board, ex-board members who contribute to analysis. And so one way they could do it is they could suggest that they will continue to raise rates or ongoing increases until clear and convincing evidence inflation is falling. That could well be taken as 50 basis points every single month going forward until a certain point is reached. So that would be hawkish on the pace, that would be hawkish on the size, and restrictive policy would be hawkish on the pace and the size. Hard to see a majorly dovish scenario here, bar them not changing at all. No change in language would be marginally dovish. Then, Q&A. Is 75 possible in July and September? If he answers this with yes to July, no to September, that could be seen arguably as slightly dovish because the market's expecting 75, 75 and 50. So if that's the expectation, and he says yes and no, then that would be roughly dovish because it's in line to possibly less. If he says yes and yes, then more hawkish. What's the terminal or peak rate? That's what the market's currently pricing. If he will answer what the terminal rate is, or peak rate, so the highest they think they're going to get to, what is it and when? If he's in agreement that that is correct, but that it will come before the end of the year, that's a faster pace, that's more hawkish. So what you try to do is create multiple different scenarios to trade. Multiple different things that could happen, and if that happens, you trade it. So you go into it very clear. But equally, you don't need to worry about the answers to these to start with. To start with, rate, dots, language. Then you worry about the answers to these once the press conference starts. And these questions will change dependent upon that, but there's rough expectations. Is there a risk of recession? Essentially, the answer to this question is, will you cut rates anytime soon? Is what that question is trying to get the answer of. And could they conduct outright sales? This is the QT side of things. So at the moment, QT is basically just winding down bonds, not reinvesting them. Could they conduct outright sales is basically, will you just start selling the bonds, which is going to drive bond yields down and effectively increase interest rates whilst continuing to raise interest rates. So that would be very, very hawkish if they did that at the same time. The reason for this question is the Bank of England had started to do exactly that. So, with all of that information at hand, go and have a go at trading this. I'll show you the result later on. The decision is June I think it might actually be the 15th, so I do apologise. I will check that. June the 15th, 2022. The policy decision is at 7 p.m. GMT, so UK time. So make sure you change your clocks to account for that. Press conferences for an hour. What I want you guys to do is through the press release, the statement is the first 10 minutes of the from 7:30 to 7:40, and then the Q&A. See if you can work out what the potential things were that happened. Now, you don't know what these things are, so the game here is not to trade it based on the information. The game here is to trade it and see if you can work out from the market reaction what was likely done. As a quick clue, if markets fly up, it's a dovish reaction to something. So ask yourself, what is that likely to have been? If it comes bang on at 7 o'clock, you know it's probably the rate or the dots. So what's the reaction? That's the game here. So go and have a go at trading it. One of the other things you will really pick up on is the volatility within the move, but your ability to trade it. You will see certain things in the order flow, in the action that goes on, that will enable you to trade this irrespective of knowing the information. One of the best ways to learn macro trading and how to trade volatile events is to trade them without knowing what exactly is going on or why the market is doing what it's doing. Because often knowing why or knowing the result of something may not match up with what the market does. And if that happens, you're then in a problem where you think it should do something, it's not doing it. Now what do? Go with what the market is doing versus what you believe it should do, and which way do you go? Not knowing what it should do means you trade it for what you see. It's a good way of trying to learn how to deal with this type of volatility and will help you as well assess what exactly happened. So go and have a go at that. We'll then have a look at this in the afternoon session. What happened on that Fed decision? Where was the action? Why did it do what it did in the way that it did? I'll see you on that session. See you in a bit.